You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, well, we are back after a week off. We had our, welcome in, Brandon.
Yeah, thank you.
We had
That was a very abrupt introduction.
Yeah.
So let me tell you a story. First of all, welcome, Hamish. Anyway,
back to the story. I had to get that out of the way because I just, it's just whatever. Anyway. Now to the main part of the podcast. No, because we had a week off.
We did
because we did our 2 live podcasts in Melbourne.
Yeah, that was crazy.
That was a ton of fun.
Live.
Yeah, and speaking of that, we actually snuck that in right before there was complete lockdown, right? Because
Have you been getting comments saying, "Oh, how did you guys record this video? You should be in lockdown, blah, blah, blah." I've been getting a few of those comments. I have to be like, yeah, no, this was recorded like a week or 2 ago. Sorry. We're not breaking any rules, we promise.
Yeah, that's hilarious. I feel like it was only a couple of days before you wouldn't have been actually able to come down. So it was good to get that done, and that was a lot of fun. If you haven't seen those episodes, then I highly recommend you go check them out. They're on the Young Investors Podcast YouTube channel with video. Yeah, so
definitely check it out on YouTube. A lot of time and effort went into putting those podcasts together, so we definitely appreciate it. And it's cool. You actually get to see us talking to each other as opposed to just listening to our voices.
Exactly. Get to put a face to the voice.
Even though like basically every single person listening to this knows us from YouTube.
Yeah, exactly.
I wonder if there's anyone. Let us know. Go to YouTube and let us know. Is there anyone that knows us from the podcast?
Yes.
And then went and looked at our YouTube channels? It's like, oh, these guys are YouTubers. I'd love to know. I bet you there's no one, but you know, might be surprised.
There has to be someone. Surely someone out there's been on Spotify, looking around,
I suppose,
found us.
Yeah. Like what we were saying before, we've got like 115,000 downloads of the podcast. Surely one of those downloads has to be from someone that doesn't follow us on YouTube, I guess.
Yeah. So let us know, and we'll be back next week to report on how many people.
Yes. I bet you, let's take bets. I bet you there's going to be no comments.
There's going to be nobody.
There's no one that's going to comment I came across from the podcast. Anyway. Tell us about our sponsor, Hamish, and then let's get into it.
Sponsor for today is Sharesight. So this episode is sponsored by Sharesight. So Sharesight is an application that I've personally been using for the past few years to keep track of my stock portfolio. And it is really just fantastic for keeping track of your capital gains, your dividends, your dividend reinvestment plans. If you, it'll do all those calculations for you if you need those. Currency gains if you buy shares internationally or you just hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and much more. And you can try Sharesight for free by heading over to sharesight.com/young investors. And that is site spelt SIGHT. And also, if you use that link, then you can also get 2 months free when you sign up for a yearly subscription.
Sweet. Thanks, Sharesight, for sponsoring.
Thank you. And we've got a few different topics to talk about today. We've got some interesting news out of the Australian government. We've got some market news, of course. It's been so volatile still. Want to talk about a case that I found of a CEO showing that they care about the long-term shareholders. That's sort of part of our investment philosophy when we're picking individual businesses, is that the management team is super important. We need to make sure we trust them and that our interests are aligned. So I thought we'd share a story on that and couple of other things, the bit more panic in the cruise line industry, but yeah.
All that and more on this episode of the Young Investors Podcast. Stay tuned.
Stay tuned.
First things first, though. Geez, been watching the market. It's actually getting interesting. That's what we were saying like the last couple of weeks. That's the time when we stop talking about the indices is the time that they get interesting. So the Australian market has gone positive 15% since the 23rd of March.
Wow.
That's pretty nuts, isn't it?
Yeah, I mean, a couple of the businesses that I was picking up while everything was kind of going crazy, some of them are up 50, 60, 70% from their bottoms. It was just such a dramatic sort of V down and then up again.
It was pretty, it was remarkable. I think we both ended up just by chance timing the market. Like timing the market exceptionally, which, I mean, in the short term anyway, of course, long term still remains to be seen. We could see markets go very negative, but it was kind of funny. I remember it was when I was in Melbourne and the markets were down like near, was it 30% at that time? And, we were staying up like 12 o'clock, 1 in the morning, watching the US markets, trying to get these stocks that we wanted. And it is remarkable. I guess that's the power of buying low. I mean, buying low is ultimately what protects you, what makes your investing super low risk. And I guess that's the main reason why we're already seeing, even in a week or two, some pretty decent returns just from the actions that we've been taking the last couple of weeks. It's like you see a stock that you're interested in, that you've done the research on, and you see it at a margin of safety price, so you know what the business is worth, and you know you're getting it for a discount, and then you take action. And if you can follow that process and be disciplined and buy at margin of safety prices, then you're pretty well protected in the long run if you're buying a high quality business.
Yeah, and I mean, as you said, we have no idea what's going to happen for the rest of the year or the
Absolutely
next 2 years. I mean, we might be talking about, oh, this is a nice 15% jump, and then the next year is absolutely devastating.
Exactly.
But it was very fascinating to me that the margin of safety prices that I had, the prices where I felt super confident that these businesses will do well for me over the long term, they really, the stock prices of those businesses really just sort of dipped into that range for maybe a day or two. And so for some of those businesses, I missed out, but some others I picked up, and then they just bounced from there. And I thought it was really strange. It was, I mean, I guess because for both of us, we've been waiting for something like this to happen where a lot of businesses, or at least more businesses, move into that range. The last time that it got close was, what was it, late 2018 or it must have been 2018. Yeah. And I was, businesses I really liked they still needed to fall quite a fair way from that point.
That was frustrating, that fall. I remember
that
because we could see it coming down and we were getting excited. I think, what was the fall? It ended up being like 15% or something
17%,
like 17%. We were going, oh yeah, come on, this is going to be it. We're finally going to see our companies come onto margin of safety prices. And it just, in most instances, I don't know if you found any deals, but for me, in most instances, it just didn't fall far enough.
Yeah, and the thing was, it rebounded so fast.
Yeah.
And for a little while there, I was thinking, wow, did I make a mistake not investing?
I was thinking the same thing. Yeah.
In my, through the rationale of my analysis, I knew that I made the right decision not investing. But for a long time, it felt like I'd just missed out on the only crash that was going to happen for the next 5 years or something like that. But fortunately, at least fortunately for me and you probably, who were sitting in a little bit more cash, it came down within another year and 5 months or something, 18 months.
Yeah, just got to be patient. That's what all the good long-term investors say, is you just got to stay patient. I mean, really, we've been investing for tops 5 years, 4 or 5 years or something. And even in the grand scheme of the business cycle or the markets just generally, that's still not a very long time. But to us, obviously, as human beings that are living our lives, 4 or 5 years feels like a very long time. So it is hard to stay patient for that long. But yeah, I mean, I guess that's why all the good long-term investors say, keep going with your 10-year plus investment horizon and just stay patient. And that's really the key to success, which we're kind of starting to see. Although a lot of the, as you were saying before, remains to be seen what the next year has in store for us.
Yeah, I mean, I'm super excited to see the reports come out where we get to see what kind of stocks Warren Buffett has been buying over this period. Which I'm not exactly sure when we'll see that, but I'm guessing it'll be probably in a few months' time when this sort of quarterly session comes out. But that'll be really interesting because I can't remember if I mentioned this on one of the other podcasts, but Warren Buffett had an interview, and the interviewer had the audacity to ask Warren Buffett if he was selling his airline stocks.
Right.
After they were down like 20%, and Warren Buffett just laughed at them. It was right at the end of the interview, and he just laughed, and that was the end of the interview.
That's ridiculous.
Because everyone knows that he's certainly not selling, but he's most likely even buying more. Which, I mean, we'll see what he's been purchasing. See how much of that, $130 billion in cash he's put to work.
Yeah. I think the only dumber question to ask Warren Buffett would be like, are you selling Coca-Cola? Also, are you selling Apple? I reckon that, I reckon you're right. I reckon we'll see that, what is it, 13F? And I think that it'll show that he's been putting a little bit of that cash to use. But I think it'll be interesting to see how much he's put to use. Yes. That would kind of give us maybe an indication of what he feels like he'll see in the next year or so. Anyway, we should move on. Let's talk about. To be honest, this is a little bit boring. But we should cover it. It's important to cover it because we're essentially going to run through the Australian Economic Support Plan that's been announced. I just did a bit of research. So obviously, the Australian government are trying to assist Australians, mostly Australians that are in need, which is obviously fair enough, in this time of, shutdown. And it's actually quite confusing because they've kind of announced multiple different things and all these payments are going to happen at different times. So I thought I'd just go through and talk about exactly what they have announced in their economic support plan over the last, month or so. So far, the government, they've announced two separate $750 payments for essentially struggling households. There's a $1,500 a fortnight JobKeeper wage subsidy and a few other policies designed to help small and medium businesses. So out of the there's two $750 payments. The first $750 payment is for those receiving basically some sort of social security benefit. So basically Australians that are doing it a little bit tougher than most, and most of those payments will be paid out by the 17th of April, 17th of this month. And then the second $750 payment they'll begin paying from July 13. And this is just a second round of stimulus, which is again mostly focused on those kind of welfare recipients. But also the second round of stimulus also focuses on small businesses. So I wrote down, where did I write down? Here we go. So with the small, medium business stuff, basically if you've got a small or medium business with turnover of under 50 million, along with not-for-profit charities, they will be eligible for a tax-free cash payment of up to $100,000. But I think that for the small and medium businesses, they need to have employees. So our businesses are not eligible. God damn it.
Not eligible. Yeah, I thought there was also something about their business having to have seen at least a 30% drop in revenue during that period, I think. And then I think it was for businesses with turnover of more than $1 billion, it had to be a 50% drop in revenue. So,
right, okay.
It's supposed to be more directed towards businesses that are clearly suffering specifically because of the events that have been happening. But
no free money, unfortunately.
No free money. No free money. No. I never. These plans are always so confusing. They're never simple. It's always here's this and then here's 10,000 exceptions to the rule.
Exactly right. It's like I cut down. Initially, I was going to say everybody that's entitled to the $750 payment, but I just broke it down to people on social security benefits because the list was that long. I would have still been explaining who gets the $750 payment.
It's
it's a pretty boring news story, but it's probably important to cover. But yeah, maybe just a word of advice, maybe just go on and maybe have a bit of a research, because you never know, you might be entitled to some of these payments yourself. So you may as well just go and have a look. So maybe do a little bit more research on them and see what you find.
I mean, it's certainly necessary because there's just been such a rapid displacement of so many jobs.
Yeah, definitely.
I mean, it's especially when it's so unexpected, I think, is when it hits the hardest, when people are least expecting it, which I think, I don't know about a time where people would have been, because the economy was doing so well.
It's doing fine, yeah.
Up until that point, everyone
global economy was humming.
Yeah, so.
Yeah, but very interesting. I mean, it's fair enough. They've got the government's got to do some sort of support plan. You can't just stand up as a government and enforce some massive business shutdown and then just be like, all right, everyone, tough it out.
Yeah,
I mean, you would lose a lot of support very quickly if you did that.
Yeah, and I mean, I'm guessing all of this spending comes with some debt that the Australian government will be taking on. Did you want to run us through that?
That's our next news story, which follows on from what we're just talking about. So ABC was reporting that Australia's net debt is likely to jump $500 billion with all that's going on. So the article reads, for the next 6 months, the federal government will be paying the equivalent of half of the country's total wage bill to prevent over 1 million workers losing their jobs. Yeah.
Half. Wow.
Yeah, over half. So they say in the mid-year budget update, Australia's net debt was forecast to peak at $392.3 billion in 2019-2020, or 19.5% of GDP before declining. But the emergency wage package will see Australia's net debt increase by a third, swelling to roughly $507 billion by the end of June, to hit 26% of GDP. So,
whoa.
Yeah, it's a lot of debt they're jumping into, but I mean, what are they going to do?
Yeah, and I mean, 500 billion is a lot, but then I've also been seeing all of the US numbers, and it seems so small relative. But then you've got to remember how small Australia really is,
tiny
in terms of population, at least.
Yeah, and GDP and
true,
market size and all that sort of stuff. Australia, I feel like sometimes we think we're more important than we actually are. But in the grand scheme of the global economy, Australia is most certainly an afterthought.
Yeah, definitely. Yeah.
It's basically just the United States, China, and the UK. That's basically.
And us just in the corner of the map on our own.
Yeah, basically. We've got a lot of space, but in terms of importance, unfortunately, we're a fair way down the list. But I think I should also talk about, there's another bit of this article here where they talk about how the government will pay for it. And they say that essentially the government will pay for the stimulus package by creating the money and racking it up as debt. Officially, it will raise money via the Australian Office of Financial Management, which borrows money on behalf of the government by selling Australian government bonds. So they're basically raising the money as they normally would. Nothing too out of the ordinary.
Interesting. Very interesting. Creating the money. Wish I could just create money.
Yeah. Geez, that'd be nice, wouldn't it?
Yeah.
Imagine Hamish Hodder, Reserve Bank of the world.
Hey guys, need $1? I've got it. Here it is.
Yeah, I'll create some money for you. No worries.
It'll be interesting to see what happens, because if they have to borrow money and there's a lot more government bonds, that would put upward pressure on interest rates, which would then put more downward pressure on stocks. So generally what happens, I think, is when the government racks up a lot of debt, there's a lot of government bonds, the Reserve Bank will print money and buy those government bonds to keep interest rates low, which would cause inflation. So will be interesting to see what happens.
Yeah. Young Investors Podcast motto. We'll have to wait and see.
We'll have to wait and see. We should put that on our banner. I'm going to do that.
On our YouTube banner or something.
Yeah.
Young Investors Podcast. Is this a good podcast? You'll have to wait and see.
Find out next week.
Find out next week. Will the quality of this podcast be a massive turnaround story? You'll have to wait and see.
You'll have to wait and see.
Oh dear. All right, let's move on. What should we talk about?
Well, actually, I've got a story here. So this is out of the US.
Yeah.
And while I think a lot of people have sort of been suffering from the stock market declines, us included, there was one man who seemed to defy all gravity.
Right.
And defy all logic and come out on top with a ridiculous amount of money. So
right.
I'm sure many of you have seen this story. It's been floating around quite a lot. But Bill Ackman, who's a billionaire hedge fund manager, so he manages money, he was able to turn $27 million into $2.6 billion in a week or in a couple of weeks. So
that's impressive.
Yeah, that's 100x. 100x his investment, and it's not a small investment either. 27.
All right. Yeah, 27 million. Man, that's ridiculous. How did he do it? I want to know.
How did he do it?
How can I achieve these returns? What stocks do I buy? Hamish, please tell me.
What stock do you buy? Well, he basically he purchased a bunch of what are called credit protections, or I think the official name for them is credit default swaps on high yielding government bonds. So
right.
What does all that mean?
Yeah, good question.
Yeah, so if you, I'm sure many of you will be interested in this. So you can go there. There's obviously some very good YouTube videos explaining this in depth if you want to know the details of it.
No, not much better than what we do.
Exactly, but it's a credit default swap, and more or less the easiest way to think about it, if you don't want to get into the details of how it actually operates, is it's insurance against the bond in case the borrower cannot pay the loan. So. Right. More or less, he was betting that a bunch of these high-yielding corporate bonds, I believe he was investing in. So high yielding meaning risky. He was betting that they would default, that the borrower, that the corporation would go bankrupt and not be able to pay those bonds. And he bought a bunch of them. And interestingly enough, so what happened was he made this bet, and no one knew he made this bet until after, of course, but he made this bet. And then throughout the week, he went on CNBC. And I actually watched this interview not knowing that he had made this bet. And I mean, he was basically just crying that the world was ending. He sounded so sad. He said that we're going into a depression era, was a quote that he said. And at the time, I thought it was really strange. And during that week, also, Warren Buffett had his interview, and Buffett actually criticized Ackman, saying that he was just spreading fear and that he wasn't providing any solutions for what investors could do, because it basically was just him complaining that the world's ending and that he's really scared. But
to be honest, some of Ackman's actions in the past make me kind of think that he's a bit of a weasel, to be honest.
Yeah, I mean, after I found out that he made that bet, it just makes so much sense. He was just going on a media spree, trying to spread fear.
Yeah.
Can you imagine if Buffett did that? Can you imagine if Buffett went on CNBC and was like, the world's ending, just crashed the stock market, and turns out he just made a huge derivative bet?
Oh my God. Imagine like that would just cripple his reputation for his legacy. But that would be so. He's probably like one of the few that could actually like shift a market with what he says.
Imagine if he
maybe he couldn't shift a market, but he could probably shift. He can definitely shift a company's stock price. We know that because it happens all the time when his 13Fs get released, and the new buys that Buffett's made causes investors just to pile money into those stocks. They're buying them just because Buffett buys them, and then the share price of those companies goes up.
Yeah.
It's the Buffett effect.
Yeah, exactly. I mean, he would just have to come out and say he's starting to drink Pepsi and
imagine that.
Tank the stock, buy up a bunch of it.
Just imagine the next annual shareholder meeting, and he doesn't say a thing about it, but just instead of having Coke up on the table, he's just got Pepsi. and him and Charlie just crack open a nice cold Pepsi and just drink it.
And every time someone stands up and asks about it, he just deflects.
Yeah,
he just says
complete deflection. That would be hilarious.
That'd be great. That'd be a great April Fool's joke. He should have done that.
Yeah, schedule it on April the 1st. That'd be crazy.
Oh dear. No, but yeah, the other thing I just had for this story was that so this will go down as one of the biggest and most successful bets in Wall Street history. Although I was doing a little bit of research after I saw an article that said that, I wanted to see what we're up against here. There was a bet by a person called John Paulson, and he made $15 billion on a single bet against the housing market in 2008. So I think that one takes the cake in this story. But $15 billion. And from that, his hedge fund, or because he made it on behalf of his hedge fund, he made $3 billion in fees on that bet.
Wow.
So
that's insane.
So it's a pretty good one. But Bill Ackman, props to you for a good bet, but I don't like the way you did it.
No, he is a bit of a weasel. I think, I don't know, I haven't really looked into him too much, but I watched this episode of Dirty Money on Netflix.
Right.
And I was talking about the Valiant pharmaceutical company. Basically, long story short, Valiant was becoming more and more profitable because they were making the prices on life-saving medication extremely expensive. Like they'd pump the prices by 100, 200, 300% on life-saving medications that they own the patents to and blah, blah, blah. And Bill Ackman at the time was, I believe he was a big investor in Valiant, and he would publicly like go out and just spread the word of how great Valiant was. And then all of this stuff came out about how dodgy that business was. And it just, I think, yeah, anyone that's out there, look up Valiant. I'm going to do it right now. Valiant share price. And there's a very noticeable drop in 2015, where it goes from about $257 per share down to about $20 per share.
Wow.
Yeah. A massive drop. This is obviously when everyone clued on. Yeah, so they lost 90% of their value in, what's that? A year, less than a year.
Wow. That's insane.
Well, I mean, we've been seeing that with Carnival, haven't we?
Yes.
Except not in a year. How's that for a segue? Should we talk about Carnival?
Yeah.
They've lost 90% of their share price in like a month.
Yeah, I want to see what it actually is, because I think some of it might have been earlier, but
Oh, okay.
it was
true.
since
It's
January.
From their peak to trough, yeah.
Yeah, so since January 26, we've got Feb, March, 2 months. 2 months, 90% down. So, yeah, Carnival's... Yeah, so, I mean, we've spoken about the cruise liners a couple of times, but
we have,
this one in particular had some news coming out of it this week, which was that management announced a couple of things. The first was that they're trying to raise $1.25 billion through the issuance of new shares. So they're trying to sell more shares. And for those who aren't aware, what happens when they issue more shares is that it adds more shares to the total. So you can think of the pie not changing, but the number of pieces that it's cut up into changing. And essentially increasing, my bad. And essentially
it is changing. It is changing. You're right, but it's changing because it's increasing.
Right. Okay. Sorry. And and then that would essentially mean that if you had one share, that one share would become less valuable. And the official term for that is dilution.
Yeah.
So I thought that was interesting. And additionally, they also announced that they are selling $3.5 billion worth of convertible bonds. So that's debt that they're trying to raise. And a convertible bond is essentially debt that has the option of being exchanged for shares if the stock price reaches a certain price.
Yeah, so if the stock price is favorable, then it makes sense to convert into shares.
Yeah, exactly. And I
was just going to say, so basically they've been... Now that their stock price is tanking, it's only now that they've come out. Well, I guess now that they're really in trouble. Now, since the stock price has gone down, like whatever it is, 80, 90%, now they've come out and said, okay, we need to dilute our shares even more and try and raise capital. Is that right?
Yeah, exactly. And generally speaking, if you're an investor in a company and you're planning to be a long-term investor, then you would only ever really want the company to sell shares if the price of those shares was overvalued.
It's like what Tesla did. Tesla did this literally like a month ago when their stock price was at $900 a share. They raised $2 billion. So they can get maximum capital raised with minimal dilution.
Yeah, and now not only has the stock price fallen 90%, so shareholders have been gutted, but now they're being diluted at 10 cents on the dollar to what their stock price was a couple of months ago. So they're selling out more of their shares to the public for a fraction of what they were previously, which is going to put even more downward pressure on the stock, because shareholders are not going to be happy with the fact that not only have they lost 90% of their value, and the stock price has to go up like 10x in order to get back to where it was, but now their individual shares are going to be diluted. Their dividend, the amount of dividends that the company pays, are going to be split into more shares.
Diluted by a lot, because obviously now to raise the same amount of capital that they're looking to raise, then they have to sell a lot more shares. So yeah, exactly right. Yeah, a real pickle for the cruise liners. But at the end of the day, I mean, if it's the difference between your company surviving and dying, then I mean, you just have to do it, right?
Yeah, I mean, you absolutely have to do it. I mean, you have to come up with the money, or else you're in trouble, or you get a government bailout. Which, I mean, I don't know if there would be a government bailout in the cruise industry. It's not an essential industry, although they've been hit so hard that I wouldn't be surprised if they got one. I
don't reckon they would. It's just I feel like it would just be deemed a non-essential part of the economy.
Yeah, and
it doesn't have that same significance as something like an airline company, which, you know, helps business generally throughout the United States or something, or Australia.
I mean, one thing I was going to say is that this is a good example of. So the reason why I was avoiding these companies, even though they were falling, and a lot of people were suggesting that they were a good investment because they were great businesses over the long term and their stock prices were down so much. But the reason why I avoided them was because their financial health was just so bad. And that didn't mean that I thought certainly these companies are going to go bankrupt. It meant that they were probably either going to go bankrupt, or something like this was going to happen, where even though they don't go bankrupt, your value in the company, your shares, become so valueless that the decline hasn't sort of given you any gain in intrinsic value. You're not buying an undervalued stock anymore because they're diluting your shares as it's going down. These kind of businesses are just, they're so uncertain that you might come out a winner, but you may very well come out a loser.
It's just a bit too speculative.
And it's exactly why just focusing on, say, a big brand name is not enough. It has to be a big brand name with a competent management team, and also with low levels of debt, a good financial health attached to the company.
I guess, I mean, overall, we're just following Warren Buffett's first rule of investing, which is don't lose money. I mean, when you're an investor, you've got every company that you look at, you have to analyze and think, is there a high chance that I could lose my money? And, you know, in these instances where you're looking at the balance sheets of, say, a cruise liner, in this case, you say, oh, actually, while it's a great company, you know, competitive advantage or whatever, if it's got that risk, that financial risk, just by looking at the financial statements, then it's probably not something that you want to get involved with. That just in itself, even though the prices come down by, say, 90%, we always say, well, the price coming down really lowers your risk. In a situation where the company's financials are not adequate, or potentially not adequate to see them through a crisis, then even if you're investing at a low price, then it's still a high risk investment, just for a different reason, I suppose.
Yeah, I mean, I just don't like companies that raise equity and sell more stock at all, full stop, because not only are you responsible for then, as an analyst, as an investor, trying to estimate the company's future cash flows in the future, you've got to estimate how much they're going to be diluted. How much is your investment going to be worth? Whereas if you're investing in a company that is not issuing shares and maybe even buying back shares, then if you just come up with an estimate for the cash flows that the whole business can produce, and they buy back stock, that's going to be, and they're responsible with it, of course, that's going to be a net benefit to you. Because not only do you have, you only have to come up with an estimation of the total amount of cash flow generated, but your shares are likely going to increase in value if the company is repurchasing shares. But I do not like to be on the other side of that.
On the flip side of it, yeah. Yeah, no, exactly right. Should we move on and talk about the next story I wanted to talk about, which is... it's still in the same vein of talking about these businesses that are really struggling at the moment with the conditions that we're seeing globally. We knew that for a couple of weeks now, we've known that the US airlines were seeking government bailouts. But now what we're seeing is the Australian airlines are starting to talk about government bailouts as well. Particularly Virgin Australia. So Qantas have actually said that they're not seeking a government bailout, but I'll tell you the story because, I'll just tell you the story. Basically, Virgin Australia is seeking $1.4 billion as a bailout from the government. And the Qantas CEO pretty much just came out and slammed them and said to, just in a I think like a press conference, just said, please don't do that, government. Just don't reward a company that is poorly managed just cause. And they also say that if Virgin gets bailed out, then Qantas wants $4.2 billion in bailouts due to their revenue being 3 times higher. But
it's kind of funny. It's like, don't bail them out, poor management. But if you do, we want our money.
Exactly right. I mean, I can kind of see where that line of thinking's coming from. I mean, the Qantas CEO did say that Qantas is not seeking a bailout, and now that Virgin's come out with this, we need a bailout, then I think it's kind of fair enough that the Qantas CEO says, well, if they're getting it, like, come on, in the interest of fairness, like, at least, bail out the whole sector, the aviation sector, I suppose, or something, But yeah, it's really interesting that the big debate happening over in the States is that there's a lot of debate whether they do get bailed out or don't get bailed out. Basically, in the case of the United States, the reason behind that is because we've had this 10-year period of economic growth, really, pristine economic conditions to grow a business, with the economy just growing and growing and growing over the past 10 years. And instead of these big airline companies really fortifying their balance sheets, instead of focusing on that, what they've decided to do is decided to reward their investors by paying, nice dividends, also, completing very generous share buyback programs. So what I essentially wanted to do is have a look at whether that's the same kind of situation here in Australia, because obviously I think it's kind of fair. Like, why should the government bail you out if you've neglected the health of your balance sheet just to reward investors with these huge buyback programs? But
I mean, that certainly makes no sense to me. I think that you definitely want to, I think it's the government's role to make sure that, say, a whole industry doesn't just completely get gutted. But if there's some businesses, if there's some airlines that are responsible and they're fine, and then there's others who are clearly not responsible and they're calling for a bailout, then in that situation, I would certainly lean on the side of letting the poorly managed airlines go under. As long as the whole airline... as long as the whole airline industry isn't going to be just completely sent into the ground.
Yeah, exactly right.
In that situation, I think that it's kind of the role of government to keep it going.
There's this interesting... This is where the whole debate or topic of too big to fail comes in. And this is where you start drifting into the area where there are some businesses that grow themselves to such a size or such an importance in a country's economy that they can start getting reckless with their, say, balance sheet management, because they know that if times get really tough and they struggle and they're looking bankruptcy straight in the face, they know that they are so important to how that country runs that the government will step in and just give them money to keep them going. Because from the government's perspective, the government just looks at it from, what actions do we need to take as a government to ensure the best functioning of our economy? And if the conclusion is that we give the banks or the airlines or whatever just free money, if that works out economically for the government, then they'll probably do that because it's just in their best interest from economic management to keep these things going. So that's where you kind of get into that debate of too big to fail. But I'm totally with you. If you have a company that you've just run poorly and therefore it's struggling, like, too bad. Like, you're bankrupt. I mean, that's the game of business. It's like survival of the fittest in business. But anyway, what I thought that I would do is have a bit of a look at some of these numbers to see whether we've got a similar situation to what's happening in the United States happening here in Australia. So I wanted to read you some of these numbers just to see what you think. So I'll start with Virgin because they're the ones that actually want the bailout. So that over the last 4 years, so this is cumulative of the last 4 years, they've had operating cash flow of $1.51 billion in total over the past 4 years. Then after that, from there, their free cash flow over the 4 years has been negative $859.5 million. However, in terms of buybacks, they've only done $6 million worth of share repurchases over that time. They've paid $156.3 million in dividends. Over the last 4 years, they've increased their cash position by $616 million. So it's now up to $1.74 billion of cash sitting there in the bank. So that's 32% of their annual revenue is what they've got lying around in cash. And they've increased their long-term debt up $135 million, now up to $2.234 billion. So what's your perspective? I'm interested to see, do you think that that's poor management? Because I'll tell you, the story that I can get out of looking at those financial numbers is not the same as what we see in the States where they're doing massive share repurchasing programs. I don't think that's the case with Virgin. I think what I'm looking at here is a case of a company that has just gone absolutely bananas with capital expenditures, probably trying to grow their business, and they've just tried to funnel so much money into growth that they've probably not fortified their balance sheet up enough versus what they needed to. What's your perspective?
Yeah, I mean, if free cash flow is that negative, they're obviously spending quite a lot in order to build out their network, which I think that's very reinvesting back into the business is very different to distributing capital when you're not profitable, which is what the US airlines were doing. But I mean, at the end of the day, they're both mismanagement. They're both decisions made by management that are going to hurt the business. And I'm just glancing at Qantas's numbers, but I'm guessing we'll get to that. But if there's other airlines in the industry that can be free cash flow positive in this industry, if it's not a factor of the industry that's causing them to be negative free cash flow, then there's clearly been some mismanagement. But I agree that it's not the same as taking on debt and repurchasing stock just to pump up the stock price.
Yeah, so just going over those numbers again, because we will talk about Qantas. So operating cash flow, so that's the amount of money that the business makes from running its business operations, $1.51 billion for Virgin. They ended up with free cash flow, so that's operating cash flow minus their capital expenditures, over the 4 years of negative $859 million. So moving now down into Qantas's numbers, so again, over the last 4 years, cumulatively, Qantas's operating cash flow has been $11.74 billion. However, their free cash, so very, very, very much positive operating cash flow. That's good. They're a profitable company from their business operations. Then the next line, we're talking about free cash flow. They've got positive free cash flow of $4.85 billion over the past 4 years. So that's the obvious thing that stands out in Qantas's case is that while both companies had positive operating cash flow, so their operations run profitably. First of all, Qantas has just a much higher amount of operating cash flow, but Qantas is also running free cash flow positive. So it means that they might still very much be investing heavily into their business, but they're not burning so much cash to grow their business that they're ending up with hugely negative free cash flow. However, if you go down another line, they've done much more in share buybacks over the last 4 years. They've done $3.29 billion worth of buybacks, I believe so. And then dividends of $876 million. They've risen their cash balance on their balance sheet up $177 million, up to $2.15 billion. So that's 12.26% of their revenue. And their long-term debt has increased by $422 million up to $3.4 billion. So again, interested to hear your perspectives. But for me, when I look at these two companies, I immediately look at, well, first of all, Qantas is a much bigger company, or a much more profitable company, I should say. But it seems like their financial management is a little bit more sound.
Yeah, I mean, I thought that immediately. That's what I thought. I was like, well, at first they're free cash flow positive, which is good. But then what they're doing with that free cash flow. So in terms of they've raised their long-term debt. So they've got $3 billion in long-term debt and they did $3 billion in buybacks. That to me is, I don't like seeing that, because buybacks should be something you do when you have extra cash just available, just around. And the fact that they were willing to have more long-term debt in order to do more buybacks, that's a decision in order to return more capital to shareholders. It's a risky decision because if their revenues drop, if their profitability drops, they have debt on their balance sheet. So, I mean, maybe it's not the worst decision in the world, and a lot of businesses make decisions like this all the time, but it's a decision. You took on more debt so that you could buy back your own stock in order to return capital to shareholders. I did just double check that, and that is, I did get those numbers correct. So in 2016, they bought back $1 billion, then 2017, $560 million, 2018, $913 million, 2019, $735 million. So they have bought back a lot of stock. Yeah, and I mean, I don't know what to really say here, but like I much prefer a business that is focused on keeping debt to a low level so that if a shock happens in the industry, they can just ride it out. And I'd much rather get less cash up front. This to me seems like a short-term move to push the stock price up than a long-term play where the company realizes that if there's an investor in here for the next 20 years, we are going to see a shock that is going to be severe. And it just so happened that it came recently, but it could have happened in the next 5 years. And if they had kept this up, then they would have pumped up the stock price and then they would have asked for a bailout.
That's a good point, actually, because what we're talking about recently with Warren Buffett, when he's spoken recently about how Berkshire Hathaway, they're always going to keep $20 billion on the sidelines as some sort of emergency fund for the company.
Yeah.
And I totally agree with you, actually. Now that I really think about it, if they've done $3.29 billion in buybacks, but they've currently got long-term debt of $3.47 billion. I mean, they're all basically the same number almost. I mean, they could have just not done any buybacks and just completely erased their long-term debt.
Yeah, and it makes sense for companies to take on debt because debt is a lot cheaper to finance than having more equity in the company because shareholders demand a higher return. That's natural. But surely when you're sitting down at that meeting thinking about what happens if our revenue drops 90% for a few months, surely you have to have a plan for that. And it just can't be, okay, we're going to get a bailout. And maybe they have access to more debt. So maybe I don't know the full story. Maybe they are protected on the downside in some other way that they can access some more debt. So in this dire worst case scenario, they can still save themselves. But I mean, if they needed to get bailed out, and which Qantas wasn't asking for one, right?
So they won't.
If they did need one, then I mean, ultimately, I still feel the same way. They made a decision to buy back stock, which is a short-term way of returning capital to shareholders in the same way that a dividend is, rather than investing in their business, keeping their balance sheet strong, so that they could survive over the long term. But I don't know.
I think the way that I'd look at it is instead of looking at, I am the CEO of Qantas, I'd look at it like, imagine that this is not Qantas, but this is like a business that I have built myself and that I own. Like I own this business. And I think in that case, I do look at those numbers and I go, oh man, yeah, I bought back so much stock, but like I could have been basically long-term debt free. I mean, that would be so powerful, because if I'm the owner of the business and this, my net worth is tied up in this business, then one of my main priorities is making sure my business doesn't fail.
Yeah.
Like making sure I get through without my business going into bankruptcy. So, and obviously if you have no debt, then you don't owe anything to anyone. So that's very powerful in avoiding bankruptcy.
Yeah, I mean, if you own a business and you plan on owning it for the next 10 or 20 years, you would absolutely be willing to take less cash, less return up front in order for that business to be still thriving and growing over a 20-year period.
Yeah, to have the assurance that it's going to be around and still doing okay. Yeah.
Yeah, exactly right. So I don't know. I don't know much about airlines specifically, so maybe there's a whole other side of this that we're not seeing. And if we are, then feel free to let us know. We always love
let us know. We'll talk about it.
Let us know. We'll find out next week, and we'll talk about it. Right. Because we always love hearing lots of different opinions. But we should jump into some.
Tell me about your story of Texas Roadhouse. That was a nice feel good story to finish off the podcast.
This is like when the news brings out puppies or something just before the ads, so that everyone feels good. No, so I found this story. This is for a company that I'm invested in, for full disclosure, Texas Roadhouse. And I mean, one of the major parts of our analysis process is making sure that the management team has our best interest. It has interests that are aligned with us, the long-term shareholder. So I thought this was an interesting story. And so the CEO, Kent Taylor, he donated his entire salary and bonus for this year coming to employees who are out of work due to restaurants being limited to delivery only. So at the moment, all of their indoor seating is closed off, and these restaurants actually don't normally do delivery, so they had to set up a whole thing in all of their parking lots, which was kind of funny. But essentially, a lot of employees are out of work, of course, because there's less demand, less need for staff. So he donated everything not his performance-based income, but his salary and his bonuses, which were $525,000 in base salary and $525,000 in bonuses, for a total of just over $1 million.
Good on you, Kent.
Yeah, good on you, Kent. And I mean, I brought this story because I think it's a good example of the kind of behavior that you see from a CEO who cares deeply about the company and also has a long-term perspective, because ultimately sacrificing a little bit of money now as the CEO in order to retain good staff members, to retain that culture of having a good team, which is so important in restaurants because the turnover is so high. And the higher that the turnover is, the more employees you're running through, people coming in and leaving, the higher that cost is going to be to consistently attract and get more employees. So to be able to retain staff members over a long time is a super important component to restaurant businesses and to keeping their costs low. So it's certainly in the best interest of the long-term shareholder to do something like this. And
That's good to
final
see.
It is. And the final piece of this story was just that he also donated $5 million to a charity called Andy's Outreach, which is actually a Texas Roadhouse charity that helps employees in times of need. So
that's nice.
That's a total of $6 million that he basically donated to staff members of his restaurants.
Yeah. No, that is good. You want to keep that culture. You want to keep, obviously, definitely a place. I feel like a place like Texas Roadhouse would be a place of, of strong culture. So it's good that he's doing this, and exactly right. It just shows you a CEO that cares about his staff, really, that cares about his business and wants to do right by his employees and just keep his company, performing as best it can for the long run, I suppose.
Yeah, and I mean, Kent Taylor is the founder of Texas Roadhouse as well, so it kind of goes hand in hand why he cares so much about the long-term success of the business. It's not just that he's running the business and he, for some reason, has some weird passion for it. It's that he created it, and he has about, I think, a 30% or 20% stake in the company himself. So it's always good to see. And I just wanted to bring it up because it's a great example of what you want to look for in a management team, so that when something goes wrong with the company, you can trust that management's going to tell you exactly what's happening, exactly how they're going to fix it, and you know the full story, compared to a manager who's hiding things from the media and doesn't want the stock price to go down and is doing dodgy things in the background. That's obviously what you want to avoid, and this is something that sort of leans on the side of being a good manager.
All right, let's wrap that one up. Let's get one Q&A question done. We should do something for Q&A. We're running out of time, that's all. I'll ask this question. This is a long question, but we'll get through it. And then we'll finish up after that, because, of course, we always want to get to at least some of your questions. So make sure if you do have a question that you leave it as a comment on the YouTube version of the podcast. Go follow us, Young Investors Podcast, on YouTube. But this question comes in and reads, I'm hearing different philosophies about investing in fundamentally sound companies when stocks are falling at this rapid rate. First one is, don't try and catch the falling knife and wait till the market has bottomed out and started to show some bullish trends. And the second is, buy stocks at a margin of safety price, and if it keeps going down, keep buying. Given that I have a finite amount of cash, I've found it hard to determine how much cash to deploy at what discounts to intrinsic value without having to estimate a bottom, because, of course, very hard to estimate a bottom. How do I determine how much cash or percentage to allocate at what discount to intrinsic value? Should I deploy all at once, or perhaps in 1% slithers, or somewhere in between? What are your thoughts on the topic of buying into stocks once they've hit those, say, margin of safety prices?
Yeah, I mean, just to comment on that first point, don't catch a falling knife, wait till the market has bottomed and start to show bullish technicals. I don't agree with that at all, because I don't look at technicals and I don't think it's possible to know where the bottom is going to be. So that whole philosophy of wait until it rebounds a little bit, or wait for there to be some positive news coming out, I think I don't agree with any of that to start off with. But I do agree with the second part, which is that you want to buy stocks at a margin of safety price. And then it's just a question. Your question is, well, how do I know? Should I put 15% of my portfolio straight into this business, and or should I slowly put it in over a couple of weeks or a couple of months? And I don't know if there's a correct answer to this. Of course, if you dump in all of your money in at once, you're obviously much more at mercy of the randomness of the stock price on that day. So if the stock is to continue to fall, you'll make a lower return because you can't add more to it. And if it goes up from that point, straight up from that point, then that'll be that's the best time you could have bought. So there's a little bit more luck involved in that strategy, I think, than if you are to spread it out over a couple of different trades, then and to sort of keep some money always on the sideline, I guess, so that if it does get worse, you can continue to add more. But there's no easy answer to that question. And I don't think anyone has an answer to that question.
Yeah, generally the way I go about it is I just adopt the strategy or the philosophy of just buying slowly. I think I agree with you, is that I would never plonk all the cash I have available in at one point. Because exactly right. It goes up or it goes down, and you just don't know which way it's going to go. And if there's a strong trend that the share prices are going down, then if it hits a margin of safety price, I'll still invest. Like, I won't hold back. I'll invest, but I probably wouldn't invest all the money I have to invest, because I want to filter that money in over time, so that if the share price goes down, I can continue to invest and in the long run, that will help me get a better rate of return overall. It sounds like from what you're looking at, you might be interested in kind of more of a mathematical way of kind of determining this. So I'd encourage you maybe to research into something called the Kelly formula. The Kelly formula is just a mathematical formula that takes into account, I haven't looked at this for a long time now, but it takes into account how good the opportunity is based on the discount you're getting to intrinsic value. And it mathematically works out what your allocation should be, or how much of your bankroll you should put into that opportunity by looking at, like, what are the odds of it going up by 20 or 50%? What are the odds of it going down by 30%? It kind of factors in those different opportunities, I think, or scenarios, and tries to mathematically model how much you should put in at the time based on the opportunity that you've got at the time. But I don't use that. I just, buy slow and don't hesitate to buy if you've got a sound company fundamentally and it's at a margin of safety price. But yeah, if you want to look that up, look up the Kelly formula. They've got it's talked about quite a bit in Monish Pabrai's book, The Dando Investor. So look up Monish Pabrai, The Dando Investor, and have a read through that book. It's a really easy book to read. You probably get through it in an afternoon or two. And then you can learn more about the Kelly formula there as well.
Yeah, I mean, one thing I will mention, I didn't mention this before, but when I do an intrinsic value calculation and I have my margin of safety price, I always have a range. So usually I'll have at the top of the range, I'll have the highest percentage growth rate that I think their cash can grow at, that I'm comfortable with, that I'm confident in. And then all the way at the bottom, I'll have one that's maybe a few percentage points below that, where it's an absolute no-brainer that I think, yes, there's absolutely, I'm very, very confident at least that they could hit that percentage return. Yeah. So I'll start buying probably towards the top range, maybe once it falls into that top range a little bit. But I won't be filling out that complete position until it gets near to the bottom of that range, where I'm now thinking, wow, this is absolutely a great price to invest. There's no doubt.
Just printing money.
Yeah, exactly right. So that's kind of the way I think about it, and maybe that'll help a little bit as well.
Yeah, cool. All right, well, shall we wrap things up there?
Yeah, we should. Thanks everyone for listening, and thanks Sharesight for sponsoring this episode again, as always. If you want those 2 free months when you sign up for a yearly subscription, head over to sharesight.com/young investors. But thanks everyone for listening. And if you want to see the video version of the podcast and be alerted when new episodes come out, then head over to YouTube and head over to the Young Investors podcast channel and hit subscribe, and then watch all of them in full and like all of them and comment 4 times on each.
Share them with your friends.
Yeah, you have to do that. But
there's a cheat code actually. If you're watching it on YouTube and you press left, right, up, down, A, B, and then share it with 100 of your closest friends, then you'll unlock a special bonus. So test that one out and see how you go.
Yeah, give it a crack. We'll see how you go, and then
we'll see you next week.
See you guys.